Attendees are in listen-only mode.
Hi, this is Kurt Kinder. I just want to touch base with everybody and kind of talk a little bit about what was a pretty rough month in the markets and kind of give you sort of an idea of what I see and put a little perspective behind what's going on. There's certainly a lot of panic going on with the markets right now, and a lot of that is driven by the Federal Reserve. Now, what's kind of interesting is the Federal Reserve came out in uh, June 20th and essentially said they're not going to do anything different. They're going to continue to buy $85 billion a month in bonds, and they're also going to keep the federal funds rate at 0.25%. So effectively, what they said is we still got easy money. And they had kind of mentioned about a possible, what they call a taper, meaning that they'll slow down the purchase of those $85 billion of bonds per month. And this kind of sent the markets into kind of a tizzy. Now, the Fed didn't say they were going to do it. They said that if the economy continues to improve, if unemployment goes down, if inflation's in check, yada, yada, if everything stays the same, we may start to remove some of it. Now, the market instantly just kind of assumed that the Fed's going to stop all kinds of quantitative easing. So this caused a panic where even diversification didn't help anybody. Bonds lost value, stocks lost value, commodities lost value, real estate, gold. I even joke, even Pokemon trading cards probably lost value. The only thing that didn't lose value was if you had money in cash. Well, since the Fed has come out after that meeting, they've come out and had the various Fed governors going around to different speaking venues and talking about, no, we still have the easy money policies are in place. We're not going to change that at all right now. So they're trying to talk the markets back off the ledge. Just to put a couple little things in perspective here. One, if the markets are reacting this badly when they think that the 85 billion a month is going to be tapered slowly over time, then you can kind of tell we're really in a market that's driven by the Federal Reserve. All these people kind of tell me that the market's justified by the high earnings and that the economy is improving, even though we can't get above 2% GDP growth. It kind of scares me. It just feels like we're part of a giant experiment here, and nobody knows exactly what they're doing. The second thing I try to put in perspective is the fact that the Fed's balance sheet has gone up from 800 billion to about 3 trillion. It'll be close to 4 trillion by year's end. But yet, if you look at the bond market, that's a $70 trillion market. So even with the Fed buying these bonds, you still have an enormous bond market and stock market out there. So even if they cut back this to zero, it shouldn't have a major impact on the overall markets because it's such a small part of the market. Sure, it's providing a little bit of juice, but you need to start putting things in perspective and see that, hey, they're not that big. The markets can still function without this little bit of extra juice that the Fed's providing. As I just mentioned a little bit, June diversification, nothing worked, but really for the whole year, diversification's not been a good tool. It happens occasionally. The only markets that are really up right now are Japan and the US. US is up about 13%, and Japan's up roughly about 30%. They had a big downturn earlier this quarter, but they've kind of rebounded a little bit, but they're about 30%. Every place else, Europe is for the most part negative. The emerging markets are really negative. If you look at bonds in general, they're down about 4.5%. Gold's gotten slaughtered. It's down about 25%. Commodities overall are down about 4%. For the most part, every commodity's down. Real estate investment trusts are up marginally, but not anything to write home about, only about 3%. So, a diversified portfolio right now is actually not doing that great, especially when you compare it to the US stock market. Most people hear how the US market's doing and they just assume that their portfolio should be tracking that. But the thing is, most other asset classes aren't doing that well. And we'll talk a little bit more about that in a little bit. But first, just kind of want to talk about bonds. This is the big thing. You hear it from the pundits and from people on CNBC. Bond rates are going to go up. The bond market bubbles collapsing. This is the start of it. And hey, I tell you, bonds had a tough May and June. They really did. They went from about 1.67% in the U.S. 10-year bond, and right now it's at about 2.5. So that's a pretty big jump for 2 months. It's a very volatile jump, but you need to again put things in perspective. So everyone's saying that bonds are done, they're dead. It's a bond bubble. It's over. We're going to see things go up. And what I always look at is people talk about bond yields from the late 70s and early 80s and how they had reached double digits as high as 16%. And people kind of assume that the fact that they were up there before, that they'll probably eventually rise back to that level again. Now, really, if you look at historically, that rise in the 70s was an anomaly. Going all the way back probably to Civil War times, we didn't have rates nearly that high. And in the 20s and 30s, we had rates pretty much where they were today. Even up through the 60s, we had very low rates. The 70s and 80s were a function of really high inflation. If you go back to the only other time we had these kind of rates in our period were very questionable times for America. I mentioned the Civil War. So rates were very high during the Civil War because, if the government's borrowing money and people thought that, hey, this government might not be around next year, we could see the Confederacy take over. So there was a very high risk premium for bonds issued by the government back then. And of course, the only other time was after we became a nation back in the 1700s. We we had some very difficult times financially, and because it was a fledgling country, that rates again when they were borrowing were very high. But beyond that, essentially once you get to about 6%, you've never seen bond rates for U.S. Treasuries go much above that outside of the late 70s and early 80s. The other thing I like to talk about is everybody's calling for the bond bubble to burst. Everybody. And famous money manager Bob Farrell, he's got his 10 rules for investing, and the ninth rule of investing is when all experts and forecasts agree, something else is going to happen. And I just want to kind of talk a little bit about why I still think that bond yields will probably, they may go up a little bit more from here, but I don't think we're going to see drastic increases. So this is sort of what the U.S. 10-year has been doing dating back to 89. And you can see it's been in basically a downward trend. Now, of course, that trend could start to continue to go up and reverse, but what you look at is every time the bond rates start to go back up, they set a lower high, and then when they go down, they go to a lower low. Now, this typically is a sign of something that still is in a downtrend. And if you look at the recent movement here, we've gone from about 1.6 to 2.5, and certainly the upper trend line, even here, gets us to about 3.8. So yeah, we could see something go up, the 10-year go up to 3.8% from here, and it would still be in a downward trend. The thing to kind of remember here is, we're looking at this downward trend, and the reason I think that we probably still can see some low yields when you look at how yields are really factored, what you should get on a return on a bond. The low yields are probably justified because bonds are basically made up of, you're going to get back what the economy is doing plus a rate of inflation. So the economy is really at stall speed. The Commerce Department came out just recently and said that the first quarter GDP was 1.7%. So this is the third revision to GDP. So it's pretty much almost the final one. And then, of course, the fourth quarter of 2012, GDP was 0.7%. So that this is pretty anemic growth. If you take the past 6 months, we essentially have about a 1.2% growth. So that's the amount you should get from the bonds for the economy. And then inflation, I know there's a lot of different ways people look at what the inflation is, but let's go with what the government uses. And if you take the consumer prices minus energy and food, we're looking at about a 1.7% inflation rate. So if you took a 1.2% for the economy and 1.7 for inflation, the 10-year should be about 2.9. So we're really kind of right, right where it should be. And the thing is, inflation seems to be uh, getting to be a bigger issue right now. We do have a downward trend with inflation. And the other thing that kind of makes me think that yields are going to stay where they are is if you look at commodities, they're kind of signaling deflation too. So gold has gotten all the headlines recently that, it's dropped quite a bit, but it could just be a signal that commodities are dropping. So if you look at the general commodities since 2011, they're down about 12%. And this chart here kind of shows you even what lumber's done. Lumber is a big part of the housing market and growth in there, and it's dropped 31% just since March. And again, this is commodities overall. This is going to be copper. You look at industrial metals, you look at precious metals. Oil has kind of held its own, but it isn't going up. So what the commodity markets are telling us is, hey, inflation is not a big risk. And typically, when you're in a deflationary environment or very low environment, bonds are a pretty good place to be invested. The other thing is, if you look at some of the economies, most of the economies are slowing down. I mentioned earlier that the US economy this last quarter was at 1.7%. It is growing, but that's kind of an anemic rate. But if you look at Europe, 9 of the 17 countries in the European Union have they've had a recession. They have negative GDP growth. China, the official wording there is they're still at 6 or 7% growth. But if you start to look at some of their numbers behind, some of the numbers that aren't as much manipulated by the government, their PMI, which is the Purchasing Managers Index, has actually dripped into a contraction. And if you look at other things in China, such as electricity usage, exports, imports, they're slowing down. So this again is a deflationary sign, and during deflation, again, bonds tend to do well. The other reason I think that bonds are probably in a decent spot. Again, they may go up from here. Nobody knows exactly what's going to happen, but I don't see a big spike in them. It's because of the massive amount of debt that we have. So this chart basically shows you private debt, which is going to be both corporations and individuals, and then government debt. And it's relative to the gross domestic product, which is the size of our economy. And what you can see is we still have about a 350% debt to GDP level. And even at the peak of the Great Depression, we barely hit the 300% mark. So we're still above the debt to GDP that we saw at the Great Depression. Now, the private debt has come down since the crash of 2008. You can see it was at one point close to 300% itself, and it's now down to about 250%. That's still awfully high relative to history. But the problem is the government debt has gone up from the 2008 crash from basically about 70% debt to GDP to now 100% debt to GDP. So when you have this massive amount of debt, you typically go into economist Irving Fisher talked about a debt deflation. And that kind of pans out if you look at historical bond rates after a debt crisis. What this looks at is two periods for the US, 1873, 1929, obviously the Great Depression, and it also looks at Japan back in 1989. And then it also, for comparison purposes, goes back for the US in 2008. And what you can see is it takes a long time to get through these debt-induced economic crises. And the bond yields in all of these segments continued to decline for several years and didn't really go up much until 20 years past the start of the episode. And just to give you kind of a quick view here, with all of those panics, those debt crises that we talked about, their long-term government bond yields eventually nestled down to about 2%. And this is a 30-year bond we're talking about. So our 30-year bond's at 3.5% right now. So if history was even close, we could see a 30-year bond drop to darn near 2%. The other thing, the average number of years after the panic to the lowest level of interest rates was about 13 years. So what does this mean? It means from 2008, if you added 13 years to that, we're looking at 2025 before we even get down to the bottom. Oh, I'm sorry, 2021. Uh, so, we could have years of low rates still. The average level of interest rates 20 years after the panic was still only 2.5%. So again, Japan's been struggling through this for years. Now they may see something change, but they've been since 1989 having rates drop because of the debt-induced panic that they went through. The other thing I like to point out for all those people that say, oh, well, when quantitative easing ends, bond rates are just going to skyrocket. Well, so far history hasn't proved that to be the case. And what this chart shows you is every one of the quantitative easings that have been started and subsequently ended by the Federal Reserve. You can see what bond rates did in the 10-year. So when QE1 started back in late July 2008, rates dropped for a little bit, but then they started to expand. So they went all the way up from the low of about 2.2% up to 4%, and then quantitative easing 1 and QE1 end. And what happened? Rates actually dropped. So even though the Fed stopped buying bonds, they took away the stimulus, interest rates went down. So then in 2010, the Federal Reserve started quantitative easing 2, QE2, and rates went up. They went up from about 2.4% all the way to 3.7%. QE2 ends, what happens? Bond rates drop again. And same thing, since QE3 has started, rates haven't gone up too much, but they have gone up a little bit. So the fact that this quantitative easing is supposedly keeping bond rates low isn't necessarily the truth. And the fact that when they take it away, that bond rates are going to skyrocket, here again, so far history hasn't proven that to be correct. So, trying to put things in perspective. Sure, bonds did jump quite a bit in May and June. They may go further. Who knows what they'll do? But there is a downward trend with them. And even if the Fed does sort of let their foot off the pedal, we could actually see rates drop from there. And if history is a guide, looking back after panics, we may see rates continue to stay very low for several years. Now, just looking at the stock market, it is up for this year. And kind of what I've done is I started to ease out of the markets a little bit, lighten up on them. Wasn't probably the best move now in hindsight, but the reason is I'm just looking at the valuation of the market. And I'm kind of looking at longer term trends. And the big thing I look at is secular movements. So sure, the market may get 8% a year over history, but it doesn't get that every year. There are periods that range anywhere from 8 to 20 years where the market goes up and where the market just goes flat. And this chart's a pretty good idea. The dark yellow here, you can see periods from 06 to 21, 16 years the market was flat. And then from 1929 to 42, and then from 1966 to 1982, 17 years it's flat. And we're here now in our 11th, 12th year of essentially a flat market. If you go from the peak of 2000 all the way to the present, we're basically at 12 and a half years. So what determines when these kind of secular markets come and go? And one of the biggest things that I look at is something called the CAPE ratio. Now this was put out by Professor Robert Schiller, and it is a cyclically adjusted price to earnings over a 10-year period. So it looks at 10 years worth of earnings that are adjusted by inflation, and then it comes up with a price to earnings based on that. Now, what P&E is, price to earnings. Basically, you take the price of all the stocks in the stock market and divide it by the earnings, and that gives you a value. And when you're using earnings over 10 years that are averaged, that's what this is looking at. So what this chart shows you is it takes all of the 10-year forward real return. So it goes back to every year and then looks from 1871 through 2010, and it looks at every year and says what's the CAPE at that year and what was the ensuing 10-year return on the stock market. And what you'll find is when the price to earnings, when the CAPE ratio is low, meaning probably a 10 or 11 down to single digits, the market is cheap and you tend to be rewarded as an investor for investing in the stock market over the ensuing 10 years. The other thing to take away is when the price to earnings is really high, then your future 10-year earnings tend to be much lower. So I broke it down into 5 quintiles. So the first one, all the way on the far left, is where you have single digit P&Es. Now, when you have a single digit P&E based on the CAPE, the ensuing 10 years has been very good for investors, returning an average of 11.4%. Right now, we are in the 5th quintile, which is all the way on the far right. The P&E based on the CAPE, the 10-year average, is at 23 right now. So at this level, if you invested today, the average investor should only expect something around 2.8% over the ensuing 10 years. Now, obviously, that's the average. So it could be higher or it could be lower. But that is sort of what you're looking at. We're very expensive historically. Another thing I kind of look at to try to get a feel for, is the market cheap or is it expensive, is something called the Q ratio. And this is put out by the Federal Reserve. Essentially what this does is it gives you an idea of is it cheaper to build a company from scratch or is it cheaper to buy a company? So it looks at the net worth of the company. And right now, if you look at it, the market is above the average by about 34%. Now, this doesn't mean the market's going to drop 34%. It's just saying that, hey, the market is expensive relative to the historical average. At the bottom of the 2009 stock market, the market was about 14% undervalued, you can see. And you can see how egregious it was back in 2000. It was at 153%. So that was the largest stock bubble we'd ever had. If you look at other historical peaks, such as 1966, or if you look back in the Depression, the Q ratio then was anywhere from 49 to 54%. So we're certainly not at those levels. And that's a good thing, because even at those levels, we know what happened in the 1930s and even through the 1966 until 1982. It was just not a good market. So, what this is telling us, it doesn't mean what's going to happen here in the next year or 2 years or 3 years or 4 years, but what this probably shows us is kind of giving us an idea that, over the longer term, maybe the next 10 years, we should expect some substandard returns. The last thing I follow is something Warren Buffett talks about quite a bit. And what this does is it takes all the values of the US stock market, so the total market capitalization, and it compares it to the gross national product. Anytime this number gets above 100%, the market is overvalued. This chart here, you can see at the peak in 2001, again, the largest bubble we ever had, we hit 140%. So clearly we were way overvalued in the market. And then in 2007, right before the 2008 crash, we were at about 105% US stock market capitalization to gross national product. Right now, we're just over 100%. Again, this doesn't tell you anything about what's going to happen in the near future. It's just trying to tell you, hey, things are awfully expensive for the US stock market. At the bottom in 2009, the stock market was at 60% of the gross national product, a very healthy ratio. Anything between 60 and 80% is a good time to be in stocks. And you can see in the 70s and 80s, it was down to 40%. That was a very good time to get in. Some other things to think about, just looking at secular bears, where they usually end, you have P&E ratios based on the CAPE at 10 or below. The blue line here kind of gives you an idea of the 2000 to 2013 P&E. We still really haven't gotten to a low level to where you could say the secular bear market has ended. Maybe it did. Maybe it did in 2009. Who knows? But historically, it probably doesn't look like we're there yet. Some other things that do have me concerned about the stock market: earnings are still doing quite well, but revenues are dropping. And as anybody can tell you, there's two ways you can increase your earnings. One is you increase your sales, and the second thing is you increase your profit margin. So if sales are dropping, that's one part that's kind of a headwind for the stock market. The profit margin, I think, is also a headwind for the stock market. The reason being that if you take corporate profits after tax and you divide it by the gross domestic product, the size of our economy, right now we are at all-time highs as far as that figure. And to put it kind of in perspective a little bit, in in 2007, when we kind of hit the peak, we were at about 8.5% corporate profits compared to the size of the economy. Right now we're we're probably at about 10.5% right now. So we're substantially above that. So if you believe that they can keep corporate profit margins this high compared to the size of the economy, then there's nothing to worry about. But the thing about earnings, they're very mean reverting. And what that says is they tend to come back to the average. And the average is about 6 or 7% of corporate profits after tax relative to GDP. So if they do mean revert over time, and again, it doesn't mean it's going to happen in the near future, but over time, that's what they do. If that's to happen, there's a big headwind for earnings going forward and the stock market. Some other little things to look at: manufacturing worldwide is definitely slowing down, but yet the markets are still continuing to go up. These two figures are very tightly correlated. So usually when one's going up, the other's going up. So we've had a break. So either the stock market's correct and that manufacturing is going to turn and catch up to the market, or the opposite is going to happen and the stock market's going to come back down to where manufacturing is. The last thing I just want to talk about is gold. So, what happened to gold? It's down 25% so far this year, and it's on the news all the time. So there's a lot of different theories as to what caused gold to drop. One theory is that the dollar got stronger, and usually, if you do look at kind of historical underpinnings, when the dollar gets stronger, the case to have gold gets weaker because gold is seen as kind of a currency. So if the dollar is losing value, you want to have gold because it should, in theory, keep its value and go up. So people are saying the dollar's gotten stronger, and that's what's causing gold to drop. That very well could be it. The other thing, like we talked about earlier, all the commodities are trending down. So this could be something just saying that there is deflation or very low inflation coming. So when all of the commodities are kind of heading south, including gold, it might be signaling that we're entering a deflationary period. I don't know. The other thing I try to tell people, I did a podcast probably 8 months ago, is gold in a bubble? And my theory was no, gold's not in a bubble. But I did say that, hey, you could have a big correction in gold. And what people are tending to forget is since gold's rapid rise in the early 2000s, we've had two periods where gold has corrected 30% or more. One of them was in 2006, and then one was in 2008. So having a 30% correction, even within a longer term bull market, is not unusual. So maybe this is just gold taking a break. I don't know. The fourth thing we hear about is Cyprus. So a lot of people didn't follow, but Cyprus essentially had to get a bailout. And one of the caveats to getting that bailout was Cyprus had to give up part of its gold. So they had to give the European Central Bank gold. So a lot of people say the liquidation of gold there is what kind of caused the problem here. I don't know what's going on with gold. I sold all our gold positions. It's the first time I've sold gold since I bought it back in 2002. But I do expect that sometime in the near future, I'll probably add some. Again, you don't want to have too much allocated to gold in your portfolio, maybe as high as 10%, but maybe 5 to 10%, somewhere in there. Some things to look at, gold and commodities, as I mentioned before, they're all kind of heading down, kind of signaling deflation. What kind of unnerves me a little bit is last time all of this happened was in 2008. Gold led the market down first. It was also the first to recover, but it's sort of a leading indicator sometimes for the markets. Another thing to think about for gold is the demand for ETFs and paper traded gold has dropped considerably, but the physical demand, people are just clamoring for it, especially in India and China. So there is a little bit of disconnect between the price for physical gold and the price for paper gold. Again, over time, this should match up, but it is something to kind of look at and wonder, what's going on? Is it really, is this something that is a movement? Is the paper showing that the movement of gold is going to head down? Or is the demand for precious metals, the actual bullion itself, going to force the ETFs and other paper to come back up? I don't know. So overall, some of the moves I made, obviously I mentioned I've kind of sold gold, and I do have a lower allocation to stocks right now than usual. That hasn't panned out. I've also kind of gotten to shorter term bond duration. So I've sold some of the longer term durations that I had and bought shorter term just for a little while, just to see what happens. Again, I think longer term bond yields are going to kind of stay in the realm that they've been in, anywhere between the 10-year, anywhere between 3.5 and 1.5%. Now, movement between there, that could be volatile. So you can expect volatility, but I don't think we're going to see the 10-year go up to 4 or 5 or 6%. I just don't see that happening with the low economic growth that we're having and low inflation, and also again the historical. But for clients' accounts, I have gone to shorter term treasuries and shorter term duration corporates just for a while, just to kind of let things settle down a little bit. But I do fully expect to get back in to longer term treasuries and corporates in the near future. So that's basically kind of how I see things right now. Would love to get any feedback. If you want to contact me, you can touch base at kirk@picketfencefinancial.com, or you can just give me a call. So I hope that this was helpful. Thanks.